Hey, Stephen Thomas with yet another housing debrief. Thank you so much for joining us. Really appreciate it. Thank you. And we're just not going to do that many slides. We're just going to free roll it like we do with our podcast because everybody is talking about these 8% mortgage rates and its impact. I've heard it from all kinds of walks, from the market's going to crash to Stephen, you don't know what you're talking about. My market is really busy. I'm still getting multiple offers. But let me describe to you what 8% mortgage rates are doing to all the markets that we track. And across the United States as well, we're seeing something very, very similar play out. So normally we peak during the summertime as far as inventory is concerned. That peak did not happen yet. We looked like we were about to hit a peak in many, many markets as well as across the United States. You could see that the peak was about to be reached, but then mortgage rates just started pounding higher and higher and higher. And it didn't stop. It has not really stopped. We've actually been above 7% since the end of July. And then it gained steam after the Fed met in September, talking about their Fed dots for the following year, which is them talking about where they think mortgage rates are going to go in the future. Not mortgage rates, but their short-term rate. But the long-term mortgage rates are kind of pegged to what the Fed talks about because they're taking into consideration where the Fed's going to be, and that's going to also it's going to change the way that they invest. And mortgage-backed securities, as well as 10-year treasuries, long-term debt, relies a lot on what the Fed's going to do with that short-term rate. And so what we have seen is that since they met at the end of September, September 20th, we've actually, the whole market has all of a sudden changed as far as bonds and mortgage-backed securities are concerned. It's like as if everybody is vacating it completely, waiting for there to be a top to mortgage-backed securities as well as bonds. And that's not happening anytime soon. We actually need to see in the data for the United States for there finally to be some economic slowdown. Unlike everything that we've received so far has been pretty positive as far as this week is concerned. I mean, we had the consumer spending was way off the charts, and it was like double what it was supposed to be. And it just set the stage for this week for it to continue to ramp up higher. And now we have mortgage-backed securities that are really high, as well as the 10-year treasury. They kind of go hand in hand because there's this love affair between the two. 10-year treasuries go up, mortgage-backed securities go up, interest rates go up. 10-year treasuries go down, mortgage-backed securities go down, interest rates go down. That's kind of what we're looking at really closely. But things have really changed, like I said, since September 20th. What that does is it's created these higher interest rates, and now the market has slowly but surely been absorbing these higher rates. The rates got even higher. They eclipsed 8%. They're now a little bit above 8% with no points, and you have to have good credit. You don't have good credit, you're definitely north of 8%. Now, if you have good credit and you put a point, you're now in the sevens. However, that is still very cost prohibitive for many, many buyers. Many buyers have been out in the marketplace and can no longer afford to purchase a home. So as a result, what they're doing is they're waiting for rates to come down so they can re-enter the market. So this is this temporary time period. It's kind of like last year at this time, we saw interest rates during the month of October continue to go up until we hit 7.37% last year. Then they went down a little bit and went back up in November. And then they started to come down after that when we started to see some changes in the consumer price index and things along that road. So right now, everybody's in a panic, like as if 8% is the new thing. And I hear other people saying, now 9% rates will totally kill the housing market. Let me explain a few different things. Number one, as far as the inventory is concerned, it hasn't reached a peak. It's going to continue to go up until we get to probably around the start of November. Then we're going to enter the holiday markets. There's already fewer homeowners coming on the market because the vast majority, it's like over 80% of all United States citizens that have a mortgage rate of 5% or less. With interest rates at 8%, it makes it a little bit cost prohibitive for a lot of people to do it, so they just simply will not do it. So as a result, we have seen the number of homes coming on the market, they have lessened. It's definitely, it's impacted it greatly, especially in high cost areas like where we do a lot of our reports for Southern California and the Bay Area. So what we're seeing is fewer homes coming on the market. Guess what happens in the month of November and December? December is home to the fewest number of homes coming on the market. Out of all 12 months, the fewest come on, and now you're taking even fewer coming on the market because fewer homeowners are opting to play. Then in November, it's the second fewest number of homes coming on the market. So we're about to hit those 2 months where there are fewer homes coming on the market, and then you have a lot of people that just want to enjoy the holidays. They thought that it was going to be easier to sell their homes, but these higher rates, it's taking a little bit longer. They're going to pull their homes off the market. So at the very end of the year, we will see the number of homes, the inventory levels go down. So that's pretty much where we are at as far as the inventory is concerned. So it's going to continue to ride up, and it's riding up at a pretty decent clip. Now, demand on the other side is not coming down like the rest of what everybody's thinking. They think that there's this collapse in demand. But let me tell you that over 30% in most of the markets that we're checking, and in some markets, it's even more. 30% of all buyers that are closing transactions are closing transactions with cash. So what we have is what we refer to as inherent demand. Cash buyers could care less about what's going on with mortgage rates. As a matter of fact, they probably prefer it because it'll make it a lot easier for them to purchase. And then there's a lot of people that are getting money from mom, dad, grandma, grandpa, uncle, aunts that are helping contribute to either doing buy downs or big down payments or even paying for homes, big chunks of money so that they can get into home ownership. Now, there's not a lot of transactions taking place, so they are a larger portion of the overall pool of the buyers that remain. And then we have just, these dual income families or even millennials that have two incomes that are large enough and they want to just purchase and they're not afraid of these higher rates because they look at the payment and they say, we can afford that. So there's actually those people out there. But with interest rates going up, it diminishes a little bit, but we're not seeing a great, gigantic drop in demand because what we have really is inherent demand. You will always have buyers. You will always have sellers. But what we're also seeing is with the inventory continuing to go up and demand going down a bit right now, because it's also seasonal, demand typically goes down during the fall and then comes down a lot during the winter. There's fewer properties as well. Well, with inventory rising and demand falling right now, what we're seeing is market times grow and the market is starting to seize it's slowing down a bit. So if you're a buyer in this marketplace, you're actually seeing that you can take your time a little bit in some markets. You got to be careful also of the markets. If you've got a market where it is the entry level price range, chances are it's still busy. What might have had 10 offers now has 4 or 5 offers, still has multiple offers. It's just fewer buyers in the marketplace. But if more products came on, those would be easily sapped up and would be left with no buyers looking within that price range. So you're just seeing in the lower entry level, fewer homes coming on the market, as well as more people that are competing against each other, but there's not as much competition as there were just, as there was like 8 weeks ago. So this is this evolution. So what will happen from here? Everybody's freaking out. A lot will happen from here. There's going to be gobs and gobs of data that comes out that it's not going to be strong, positive United States economic growth for a long time. There are a lot of headwinds that I will talk about later on in other podcasts, including forecasts and things like that. But let me tell you a couple of them that are off the top of my head. Savings. Now, consumer savings has been dwindled down, where they've spent all the money that's been put into their pockets by the federal government and around the world. Everybody they've been given money when we went into the pandemic, and now they're sitting. They spent so much of their money that they have in their savings accounts less than where they were prior to COVID. So that's where we're at. Plus, we have credit card debt that has been rising. You can only do that for so long and sustain that kind of lifestyle that you enjoy, and then you're going to have to pivot. A lot of people are pivoting out there. So we're going to see this pivot right now, and you're going to start to see in the data. It's a slow progression. This isn't a sudden stop. This is slowly but surely. We have students that are paying their debt, also eats into consumer spending. housing. We have just a lot of commercial loans that are coming due that will happen over the course of the next several years. That is trillions of dollars. This is all there's these headwinds that slowly but surely we'll see that everything that the Federal Reserve takes time, and it's this long wick. Eventually, things will slow down. They will slow down. So we'll just wait and see for this to happen. When it does happen, you're going to see an evolution in the real estate market because there will be a change in the overall economy. There'll be a slowdown. The Fed will have to pivot regardless of what they say. They will have to counteract this slowdown that is occurring, and a lot of it is because these bond prices and interest rates have gotten to such a high level that even if you listen to the Fed, what they're saying right now is they're most likely not going to do anything in November. If you listened to them in September, just last month, when they were just initially coming out with, after their meeting, they were saying that it looks like it's still on the table, that type of thing, and people thought that they might do it in November, for sure in December. But most likely, the way everything's reading, most likely they're going to be doing nothing. And that's what they should do, nothing. Because in time, all of this aggressive rate hiking will take root. So that is what's going on there. As far as the rest of the year is concerned, we're going to see market times that go up just like they did last year. It was continuing to slow until we got to about middle of November, and then market times came down because inventory levels came down, and demand, if you look at demand curves across for all markets, it's like we peak in the spring as far as demand's concerned, but slowly but surely we watch it go down lower and lower and lower. But you know what? It has been kind of flat to slightly down all year long because it hasn't been that high. So what we've seen is demand's coming down. It's only going to continue to do that through the end of the year. It's not going to be this giant down because we're dealing with inherent demand. So for the rest of the year, things will slow down a little bit until we get to the middle of November, and then it's going to come down. And then we're also going to see inventory peak coming up in November and then come down. And then we're going to start off next year with very few homes on the market, and a lot can change between now and the start of the year in terms of mortgage rates. But we will be watching the whole entire time, letting you know what's going on in the market, and we'll be bringing you the latest and greatest so that you can make proper decisions for you, your family. It's just about us wanting to set expectations based upon real hard facts. Well, thank you for joining us once again for a housing debrief. I hope you have a great finish to your week, and we will see you on the other